There are usually some very mild but widespread benefits for consumers from lower energy costs, but concentrated negative impact for producers. So from the credit perspective, it is a terrible, terrible blow, even if you share the benefits of falling energy costs for many consumers. And then if we think about the particular moment in time where we are right now, where gasoline demand appears to be lower on a weekly basis than any time in the United States that we've seen since records beginning in 1991. So people are not driving, they're not filling up the gasoline tank, and they're not really benefiting from that savings. If we take a look at the energy industry in the United States, it seems that we've had a very big drop in refinery use of energy. So they're not making the products, and that makes sense when jet fuel demand is also lower than any observation we can see. But weekly crude oil production, again, is barely fallen. It's only begun to fall a little bit in the United States. And so you've been covering this a lot. This is going to be a sector that's unfortunately harmed from an employment perspective. So it's that combination of things that we have to think about, at least over the very short term, being a very concentrated negative impact.
Well, that's an interesting way to think about it, and very helpful. You're also the chief economist there. Talk to me about how long you think this sort of slumber in the economy persists, how quickly it might come back. Would you expect it? Let's say unemployment goes to 20%. How quickly would you see that coming back in an economy that lumbers back to health, doesn't snap back to health?
Right. So I think that there are going to be a lot of distortions here that can create some really extreme readings that could be kind of misleading. I'm going to give you an example from the theater industry. Last I saw, we had a couple weeks where U.S. Movie theater receipts were $5,000 per week. And in the year ago week, they were $200 million. So if we got up to $10,000 per week, we could have a 100% rise, but it's still basically nothing. Now, I don't want to, again, say that that's really the outlook for the economy. But again, if you fall 50%, you could have a 100% rebound just to get back to the same level. So we have to think in those terms. What I think we are likely to see is that about a quarter of all workers in Western economies are unable to perform their jobs in the second quarter, whether we count them as unemployed, whether we simply have them furloughed, or just they're unable to do their jobs but still have them. So for GDP, this is going to be a very severe drop. In the United States, if we annualize that drop, as we always do, a 10% drop becomes a 40% annualized pace of decline. If we get half of those workers back in the third quarter, you got to remember those gains and losses are asymmetric. We think that that could be a 30% annualized rebound, even if you get halfway back. So in many respects, we're expecting a long period here to get to a new high in the economy. There are particular sectors, travel, hospitality, traditional retail. These are things that will be negatively impacted. Some elements of real estate will come back slowly. But I think you can still, once we get past the second quarter period, there can be a pretty sharp rebound. And I think you're seeing that already in China's economy. And that's roughly indicative.